this is LVMH. They were down about 5% on the release, but they were up a little bit. So I assume that they finished somewhere kind of flat on the week, although I'm not entirely sure about that. Revenue came in at 80. This again in euros, 84.7 billion, up 1%. Profit from recurring ops, which is their posh way of saying operating profit, was 19.6 billion. That was down 14%. About a 23.1% operating margin, which is still decent for a company of this size doing what they do. 10.5 billion in operating free cash flow. That was up 29%. They said that they spent about 5.5 billion in operating investments. This was them reinvesting into the areas of their business which they believe needed it. Net profit down about 17% year on year. This was driven by an extra 5.2 billion in tax and some exchange rate pressures. In terms of segments, the big arm of the business is fashion and leather. That was 41.1 billion, down 1%. These are all organic. Selective retailing, 18.3 billion, up 6%. This was pretty much all Sephora, or Sephora, however you pronounce it. Wines and spirits was 5.9 billion, down 8%. So if you're wondering why your Diageo shares haven't been doing very well, that's why. Perfumes and cosmetics, 8.4 billion, up 4%. And watches and jewellery, 10.6 billion, down 2%. This drop in EPS has LVMH about 27 times earnings, so not the cheapest, but it's actually quite a bit cheaper than the rivals. Hermes is in the 60s. I'm expecting Bernard to be on the lookout for some acquisitions this year. In the call, Bernard was bullish about future growth, but not bullish about France. He said, I've just come back from, well, I won't do it in his accent because he's not going to read it like that. I've just come back from USA. And I could see the wind of optimism reigning in that country, he said. When you come back to France, it's a cold shower. When you come back to France and see that we're about to increase taxes by 40% for companies that manufacture things in France, it's incredible. It's the ideal way to encourage offshoring. And I had a look into this because this was news to me. I didn't see this. But French lawmakers on Thursday are beginning negotiations on Prime Minister's Francois Bayrou's proposed 2025 budget, which includes 53 billion euros of tax hikes and spending cuts meant to rein in France's skyrocketing budget deficit because they all want to retire at 53. And if you tell them it's 54, they burn the city down. So among these measures is an increase in the corporation tax rate, Steve, which would climb to 41.2% for a profitable corporation with a turnover of more than 3 billion. So LVMH, as you've just heard, is well dead in the centre of that one. But don't worry, Finance Minister Eric Lombard said the exceptional measure is only going to be in place for 1 year. Arnault said, nobody believes it. He was actually on the sidelines of the press conference shouting that at him. So economic outlook in France is looking pretty grim. Arnault said LVMH, which obviously owns Louis Vuitton, Dior, Fendi, Moet Chandon, is seriously considering opening factories in the United States. Such a move is going to help it avoid these tariffs that Trump has promised to enact on foreign goods made elsewhere and sold in the United States. A stunning move from France. I would be amazed if they don't see capital flight by putting a 40% raise in taxes. But the most important thing, Steve, is that Bernard told us that the dividend is going to remain flat.
Oh, good. I was waiting for that bit. I was just busy writing down all these meaningless other numbers and facts about politics and stuff, and just waiting for you to tell me about that mighty dividend they have, which, as I understand it, currently yields just under 2%. Okay, so stock for this week is actually still well behind. It went up a bit, but it's fallen away and is now about 4.5% down on the last week or so, which is fine. 13% up since the start of the year, 8% down on the last 12 months. You pick your favourite timeline that you want to have a look at here. I mean, the kind of issue with these guys and with a bunch of other companies as well that I've started hearing related and similar noises from is my New Year's resolution was to stop running into value traps, which is to say, not just buying stuff, not just because they're down, that's a disservice to myself here, but with no sense of when they might be about to turn around, because the concern wasn't that these are bad businesses or even overpriced businesses. The point was more that they can stay undervalued for a very long time. And if you have to wait 3 or 4 years to get your thing back to your price target, which is 30% higher, well, you may as well have indexed in some cases. Especially over the last couple of years, that's been quite a good way to underperform. So the encouraging thing here is that sales are starting to look up in a few different places here, not in the Diageo division, as we call it. We seem to say this quite a lot of there's a good leading indicator. Diageo reports, by the way, this coming week, and that will no doubt be terrible. I have reasons for worrying about Diageo again that are not to do with LVMH, but it's always nice to have some more. They signs that sales are moving in the right direction. Where that goes, the rest will follow, I think. I also saw basically the UK's version of LVMH, which is Dr. Martens, saying US sales were actually starting to pick up a little bit on the 27th of January, which is about 4 days ago. Now, the Doc Martens share price could not have cared less about this. It was already up this year for basically no reason whatsoever other than a change of CEO. Not that there was much. It's not the previous CEO's fault, the fact that that no one's buying this stuff in the States because consumer spending is down. But it went up for no discernible reason and then stayed flat when I thought it probably should have gone up. But you're starting to see demand for kind of cyclical, relatively durable, luxury-ish goods purchases coming through here, and yeah, it's not quite in the same league as LVMH, but when you start seeing sales start to recover, then stocks begin to become a bit more interesting with these things. It's around 25 times earnings, but those are quite depressed earnings, I think, and this is potentially an interesting time, I think, to be starting to have a look at this, not just because it's down compared to a year ago, but because it's down and starting to see things moving in the right direction too. I think that top line is important. Bernard Arnault has, for as long as I have looked back into his backstory, been exceptionally good at playing politics. He's also been exceptionally scheming, Machiavellian, and just outright loud. So shouting, no one believes it at people. I'm kind of wary of capital flight from France as well, with an increased tax regime. That wouldn't massively surprise me to see something happen there. But Arnault's a smart guy, and I think he's actually a good candidate. I mean, he's the only candidate to steer LVMH through this, and I suspect that he may well do that quite well.
Yeah, and he's bound to have seen this kind of thing before, Steve, as well. He's been the CEO of this company for a very long time, so there's not anything that he hasn't steered LVMH through, or has something that he can reflect on, and this will just be another thing for him. And if they go and do some manufacturing in America, I would expect sales in America to push on as well, which is not exactly a bad thing. So yeah, I was fairly impressed with these earnings, Steve. I think this is a pretty fine looking company, and we're going to see people look at those metrics and say, well, the PE is a bit high. Yes, but if you normalize these earnings and you look at that, they're in a down cycle, and you look at what an up cycle kind of earnings look for, which is how you want to be valuing this kind of thing, and you want to put a premium on it because the brands it has are the best brands in the world, and the ones that it doesn't own, it shortly acquires. It's a really fine outfit, and it doesn't take an awful lot of imagination for you to pull those earnings into the kind of 20 mark. And if you say the market average is 15, 16, 17, maybe 18 PE, depending on how you feel about low interest rates and whether we head back there, to get to 20 or to 22 on something like LVMH, I don't think is a massive stretch, Steve.
Nope, I wouldn't see it that way, even in the kind of top end of these things. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.